Have you ever felt paralyzed by financial decisions? Maybe you've thought, I want to invest, but I don't even know where to start. How do I know if I'm making the right money moves? What if I mess up and lose everything? You're not alone. Most people struggle with money simply because no one ever taught them how to manage it. But today, that ends. In this final part of our series, we're tackling the most burning personal finance and investing questions, the ones that keep people stuck and afraid to take action. And that's not all. We're also giving you a financial freedom toolkit, a carefully curated list of the best resources, tools, and strategies to help you continue your financial journey long after this video ends. If you've ever felt like you're missing a key piece of the puzzle when it comes to building wealth, you're in the right place. Let's dive in.
You've learned a ton about financial freedom in this video. But maybe you still have some burning questions swirling in your mind, especially if you're new to investing. Don't worry, you're not alone. In Section 11, we're tackling the most frequently asked questions, FAQs, about investing and personal finance to give you clarity, confidence, and answers to your common doubts and concerns. Let's dive into these FAQs and demystify investing once and for all. No more confusion, no more overwhelm. Just straight answers to help you move forward with confidence. FAQ number 1. How much money do I need to start investing? How much money do I really need to start investing? Do I need to be rich to begin? This is a huge question for many beginners. Answer. You can start investing with very little money, even as little as $10 or $50. You do not need to be rich to start investing. Thanks to fractional shares and low-fee index funds, investing is now accessible to almost anyone, regardless of their current income level. Many online brokers have no minimum account balances to open an account, and you can buy fractional shares of index funds for just a few dollars. The key is to start small. Start now, and be consistent. Don't wait until you have a lot of money. Time is more valuable than the amount you start with. Start investing with whatever you can afford today. FAQ number 2. How risky is investing in index funds? Index funds sound great, but how risky are they really? Could I lose all my money? Risk is a natural concern when it comes to investing. Answer. Investing in index funds does involve risk, as does any investment. But index funds are generally considered to be lower risk than investing in individual stocks. This is because of their diversification. You are investing in a broad basket of hundreds or thousands of companies, not just relying on the performance of a single company. Market downturns and fluctuations are normal in the stock market, and your index fund portfolio value will go up and down over time. There will be periods when your portfolio value decreases, sometimes significantly, like during market crashes. Losses are possible in the short term. However, historically, the stock market and broad market index funds has shown a strong upward trend over the long run. If you are investing for the long term, 5, 10, 20 plus years, the historical odds are in your favor that your index fund investments will grow significantly over time, despite short-term volatility. Risk management strategies like diversification and long-term focus are key to mitigating risk in index fund investing. Investing is not risk-free, but index funds offer a relatively lower risk and diversified way to participate in the long-term growth of the market. FAQ number 3. Do I need to be a financial expert to invest? Do I need to be a financial expert to understand and invest in index funds? Is it too complicated for a beginner? Many people feel intimidated by the world of finance and investing. Answer. No, you do not need to be a financial expert to invest in index funds. In fact, index fund investing is designed to be simple and accessible for beginners. You don't need to be a stock-picking guru or spend hours analyzing market charts. The beauty of index funds is their simplicity. You are essentially investing in the entire market with one single investment. You don't need to choose individual stocks or try to time the market. It's investing made easy for ordinary people. Basic financial literacy and a willingness to learn the fundamentals, which we've covered in this video, are sufficient to get started with index fund investing. You can learn more as you go, but you don't need to be an expert to take the first step. Simplicity is a strength of index fund investing, especially for beginners. FAQ number 4. How do I choose the best investment platform? There are so many online brokers and investment platforms. How do I choose the best one for me? It feels overwhelming. The abundance of choices can be confusing. Answer: focus on a few key factors when choosing an investment platform, especially for index fund investing. Low fees. Prioritize brokers that offer low or no commission trading on stocks and ETFs, including index funds, and low account fees. Fees can eat away at your returns over time, so low fees are crucial. Index fund selection. Ensure the platform offers a wide range of low-fee index funds to choose from, including S&P 500, total stock market, international, and bond index funds. User-friendliness. Choose a platform with a simple, intuitive, and easy-to-use website and mobile app, especially if you are a beginner. You want a platform that is easy to navigate and understand. Reputation and security. Select reputable and well-established brokers that are regulated and have a strong track record of security and customer service. Vanguard, Fidelity, Schwab are often recommended, but do your own research. Minimums, or lack thereof. Check for account minimums and investment minimums. Ideally, choose a platform with no or very low account minimums and low minimum investment amounts so you can start small. Research and compare a few top-rated online brokers based on these criteria, and choose the one that best fits your needs and preferences. Read reviews, compare fee structures, and try out their demo accounts if available. Don't get paralyzed by overanalysis. Pick a reputable, low-fee platform and get started. FAQ number 5. What taxes do I have to pay on my investments? What about taxes? Are investments heavily taxed? How do taxes work with investing? Taxes are an important consideration in financial planning. Answer: yes, you will likely have to pay taxes on your investment profits, capital gains, and dividends. But tax-advantaged accounts can help you minimize or defer taxes significantly. Taxable brokerage accounts. Profits from selling investments in a regular taxable brokerage account are typically taxed as capital gains tax. Rates vary depending on your income and how long you held the investment. Dividends are also taxed as dividend income. Tax-advantaged retirement accounts, e.g., 401k, IRA in the U.S., or equivalent in your country. These accounts offer tax benefits to encourage long-term saving for retirement. Contributions may be tax-deductible, reducing your current taxable income, and/or your investments can grow tax-deferred or tax-free within the account, depending on the account type and country. The specific tax rules for investments vary significantly depending on your country and the type of account. It's essential to understand the tax implications of your investments and to utilize tax-advantaged accounts where possible to minimize your tax burden and maximize your long-term returns. Consult with a qualified tax advisor in your country for personalized tax advice. Don't let taxes scare you away from investing, but be tax-aware and plan strategically. FAQ number 6. How can I avoid scams and financial fraud? I'm worried about scams and financial fraud. How can I protect myself and avoid getting ripped off? This is a valid and important concern, especially in the online world. Answer: protecting yourself from scams and fraud requires vigilance, skepticism, and following these key principles. If it sounds too good to be true, it probably is. Be highly skeptical of investment opportunities that promise guaranteed high returns with little or no risk. Legitimate investments always involve risk. Research and verify before investing. Before investing in anything, do your own research and verify the legitimacy of the investment and the company or person offering it. Check for registrations, licenses, and regulatory information from reputable sources in your country. Beware of high-pressure sales tactics. Scammers often use high-pressure tactics to rush you into making quick decisions without proper research. Legitimate financial professionals will not pressure you. Take your time, do your due diligence, and never feel rushed to invest. Don't invest in things you don't understand. Stick to investments that you understand. If you don't understand how an investment works, how it generates returns, or what the risks are, do not invest in it. Protect your personal information. Never share your passwords, PINs, or sensitive financial information with unverified individuals or websites. Be cautious of phishing emails, suspicious phone calls, and unsolicited investment offers. Seek advice from a fee-only financial advisor. If you're unsure about an investment or need personalized financial guidance, consult with a fee-only financial advisor, as we discussed in Section 6, who can provide objective advice in your best interest without selling you products on commission. Vigilance, skepticism, and due diligence are your best defenses against scams and financial fraud. Be informed, be cautious, and protect your hard-earned money. FAQ number 7. What if the market crashes after I invest? What if I invest in index funds, and then the market crashes? Will I lose all my money? Should I wait for a better time to invest? Market crashes are a common fear for investors, especially beginners. Answer: market crashes are a normal part of the investment cycle, and while they can be scary, they are also potential opportunities for long-term investors. Trying to time the market, waiting for crashes to buy or trying to sell before crashes, is generally a losing game, even for professionals. Historically, the stock market has always recovered from every crash and gone on to reach new highs over the long term. Market downturns are temporary, while long-term economic growth has been a persistent trend. During market crashes, stock prices go down, including the prices of index funds. Yes, your portfolio value will likely decrease in a crash. However, if you are a long-term investor, market crashes are not a reason to panic or sell. In fact, they can be seen as opportunities to buy more shares of great companies through index funds at lower prices, essentially buying at a discount. Warren Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. Market crashes are times when many people are fearful and selling, which can create buying opportunities for long-term investors who remain calm and rational. Don't try to time the market. Focus on long-term investing, diversification, and staying consistently invested through market ups and downs. Market crashes are temporary setbacks in the context of long-term wealth building. Stay calm, stay invested, and view market downturns as potential opportunities. FAQ number 8. How can I diversify beyond index funds? Index funds are great for diversification within the stock market, but how can I diversify my investments even further, beyond just stocks and bonds? Diversification across different asset classes is a smart strategy for more advanced investors. Answer: yes. You can absolutely diversify your portfolio beyond just stock and bond index funds. As you become more knowledgeable and comfortable with investing, consider exploring other asset classes to further diversify and potentially enhance returns and reduce overall portfolio risk. Examples of other asset classes to consider for diversification beyond stocks and bonds include real estate, rental properties, REITs. Real estate investment trusts provides potential income, appreciation, and diversification from stock market correlations. Commodities, gold, silver, oil, agricultural commodities, often accessed through commodity index ETFs, can act as an inflation hedge and diversify portfolio, though they can be volatile. Private equity and venture capital, typically for accredited investors investing in private companies or startups. Higher risk/higher potential reward, less liquid. Cryptocurrencies, Bitcoin, Ethereum, etc. Very high risk and volatility emerging digital assets. Extremely volatile and speculative. Consider only a very small allocation if you choose to invest. Exercise extreme caution and do thorough research if considering cryptocurrencies. Alternative investments, hedge funds, private debt, etc. Typically for sophisticated/high net worth investors, more complex and often less liquid investments, generally not recommended for beginners. For most beginners, sticking primarily with a well-diversified portfolio of low-fee stock and bond index funds is a solid and sufficient starting point. As you gain more experience and financial knowledge, you can gradually explore adding other asset classes to further diversify your portfolio, if it aligns with your financial goals, risk tolerance, and time horizon. Diversification is a journey, not a destination. Start with a solid base and expand strategically over time. FAQ number 9. How can I manage my emotions when investing? Investing can be emotionally challenging. How can I manage my emotions? Fear, greed, panic, when the market goes up and down. Emotional discipline is crucial for long-term investing success. Answer: managing your emotions is a critical part of successful long-term investing. Market volatility and fluctuations are normal, and emotional reactions can lead to poor investment decisions, like selling low in a panic or buying high in a frenzy. Develop these strategies to manage your emotions. Long-term perspective. Focus on your long-term financial goals, years, decades, not on short-term market fluctuations. Remind yourself why you are investing and what you are working towards. Zoom out and see the bigger picture. Automate your investments. Automatic, recurring investments, as we discussed earlier, can help you remove emotion from your investment process. You are consistently investing regardless of market conditions, taking the emotional decision-making out of the equation. Ignore short-term market news and noise. Avoid constantly checking your portfolio or obsessively following short-term market news and expert opinions. This often fuels emotional reactions and anxiety. Focus on long-term fundamentals, not short-term noise. Education and knowledge. The more you understand about investing and market history, the less likely you are to panic during market downturns. Knowledge breeds confidence and reduces emotional reactions based on fear or ignorance. Continue your financial education. Don't panic. Remember, market cycles are normal. Remind yourself that market downturns are normal and temporary. Historically, markets have always recovered and gone on to new highs. Market cycles are a natural part of investing, not a reason to panic. Emotional discipline is a learned skill in investing. Practice these strategies to manage your emotions. Stay calm during market volatility, and make rational, long-term investment decisions, not emotional reactions. Master your emotions. Master your investing. FAQ number 10. Where can I learn more about personal finance and investing? Where can I go to learn more about personal finance and investing and continue my financial education journey? Lifelong learning is essential for financial success. Answer: there are tons of amazing resources available to continue your financial education journey. Here are just a few. Books. Start with classic books like Money, Master the Game, of course. The Intelligent Investor, Rich Dad Poor Dad, The Millionaire Fast Lane, The Simple Path to Wealth, The Psychology of Money, and many more. We'll recommend more in Section 12. Websites and blogs. Reputable websites and blogs offer tons of free financial information and articles, e.g., Investopedia, The Balance, NerdWallet, personal finance blogs in your country. Podcasts. Listen to personal finance and investing podcasts during your commute, workouts, or free time. Search for Personal Finance Podcasts in your podcast app. YouTube channels. Channels like Sabiduria N Palabras, Winking Face, and many others offer valuable financial education content for free on YouTube. Online courses. Platforms like Coursera, Udemy, Skillshare, etc. offer affordable online courses on personal finance and investing from beginner to advanced levels. Libraries and public resources. Don't forget your local library. Libraries offer access to books, magazines, and often free financial literacy workshops and resources. Financial advisors. Fee-only. Consider consulting with a fee-only financial advisor for personalized guidance and a financial plan tailored to your situation, as we discussed in Section 6 and FAQ number 6. Commit to lifelong financial education, as we discussed in Section 7 and Action Step 7 of Section 4. The more you learn, the more confident and successful you'll become in your financial journey. Keep learning, keep growing, and keep building your financial freedom. And those are just 10 of the most frequently asked questions about investing and personal finance. We hope these FAQs have given you clarity, answers, and confidence to move forward on your financial journey. But we're not quite done yet. To further empower you, in our final section, Section 12, We'll provide a curated list of essential resources to help you continue your financial education and build your path to financial freedom. Stay tuned for even more.
Congratulations! You're almost at the finish line of this incredible journey. But financial freedom is not a destination. It's a continuous journey of learning and growth. In this final section, Section 12, we're going to give you your Financial Freedom Toolkit, a curated list of essential resources to help you continue your financial education, take action, and accelerate your path to financial independence. These are highly recommended resources: books, websites, platforms, tools, and communities that can provide ongoing support, knowledge, and inspiration as you build your financial future. Let's equip you with the best resources to go even further on your journey. Essential books for your financial journey. Your Financial Library Starter Kit. Books are your mentors in print. They offer in-depth knowledge, timeless wisdom, and diverse perspectives on personal finance and investing. Here are essential books to build your financial library. Money, Master the Game by Tony Robbins, mentioned throughout this video. A comprehensive and engaging guide to personal finance and investing, covering index funds, asset allocation, and psychological principles. Start here if you haven't already. The Intelligent Investor by Benjamin Graham, the classic Bible of value investing, considered by many to be the greatest investment book ever written. More advanced but full of timeless principles. For serious investors who want a deeper dive into investing philosophy. Rich Dad Poor Dad by Robert Kiyosaki, a personal finance classic that challenges conventional wisdom about money and emphasizes financial literacy, assets, and entrepreneurship. Mindset shifting and motivational. The Millionaire Fastlane by M.J. DeMarco, a more contrarian and direct approach to building wealth, focusing on entrepreneurship and creating scalable businesses. For aspiring entrepreneurs and business builders. The Simple Path to Wealth by J.L. Collins, a straightforward and no-nonsense guide to achieving financial independence through low-fee index fund investing, simplifying complex concepts. For those who want a simple, actionable index fund strategy. The Psychology of Money by Morgan Housel explores the psychological and behavioral aspects of money, understanding how emotions and biases impact financial decisions. For understanding the human side of money and investing. I Will Teach You to Be Rich by Ramit Sethi, a practical and actionable guide to personal finance for young adults, covering budgeting, saving, investing, and negotiating. For millennials and Gen Z seeking practical, step-by-step advice. Start building your financial library with these essential books. Read them, reread them, take notes, and apply the wisdom to your own financial journey. Knowledge is power, and books are a powerful source of financial knowledge. Top websites and blogs for financial education. Your online financial learning hub. The internet is a treasure trove of free financial information. Here are top websites and blogs to make your online financial learning hub. Investopedia, investopedia.com, a comprehensive financial dictionary, encyclopedia, articles, tutorials, and market data. Your go-to for financial definitions and explanations. The Balance, thebalance.com offers articles, guides, and practical advice on all aspects of personal finance, from budgeting to investing to debt management. Broad and reliable personal finance information. NerdWallet, nerdwallet.com provides reviews and comparisons of financial products, credit cards, loans, brokers, calculators, and articles on personal finance topics. Useful for comparing financial products and making informed decisions. Bankrate, bankrate.com offers rates comparisons for financial products, mortgages, CDs, savings accounts, financial calculators, and articles on personal finance. Great for comparing rates and finding the best financial deals. The Motley Fool, Fool.com offers investment advice, stock recommendations, subscription-based for premium features, and free articles on investing. For more active stock investing ideas and research, use with caution and do your own due diligence. Blogs of reputable financial advisors and planners. Many fee-only financial advisors and planners have blogs with valuable free content on personal finance and investing. Search for fee-only financial advisor blogs in your country for local and personalized insights. Make these websites and blogs part of your daily or weekly financial learning routine. Explore their articles, use their calculators, and stay informed about financial news and trends. The internet is a vast financial library at your fingertips. Use IT to your advantage. Recommended investment platforms for index funds. Your low-cost brokerage options. Ready to invest in index funds? Here are recommended online brokerage platforms known for their low fees, wide index fund selection, and user-friendliness. These are examples. Always do your own research and check platforms available in your country. Vanguard, founded by index fund pioneer Jack Bogle. Vanguard is a top choice for low-cost index funds and offers a wide range of Vanguard index funds, VOO, VTI, VTSAX, etc., with very low expense ratios. Generally considered a leader in low-cost investing. Fidelity, another major brokerage with a strong reputation and a wide selection of low-fee index funds and commission-free trading, offers its own Fidelity Zero index funds with zero expense ratios, user-friendly platform and good customer service. Schwab, Charles Schwab, a well-established and reputable brokerage offering low-cost index funds, commission-free trading, and a wide range of investment options. Known for good research tools and customer service. Interactive Brokers, a more advanced platform often used by active traders and international investors, offering very low margin rates and access to global markets. May be slightly more complex for beginners but offers very competitive pricing. Platform examples specific to your target country audience can be added here, e.g., local online brokers known for low fees and index fund access. Research and compare these and other platforms available in your country and choose the one that best suits your needs, comfort level, and investment goals. Consider factors like fees, index fund selection, user-friendliness, and customer service. Open an account and start investing in index funds today on a platform that empowers you. Best budgeting apps and tools. Take control of your cash flow digitally. Want to modernize your budgeting and money management? Here are best budgeting apps and tools to take control of your cash flow digitally. InAb, you need a budget. InAb.com, a highly rated budgeting app based on the envelope system philosophy, emphasizes proactive budgeting, giving every dollar a job, and tracking every expense. Subscription-based but highly effective for detailed budgeting and cash flow management. Mint.com, a free and popular budgeting app that automatically tracks your income and expenses by linking to your bank accounts and credit cards. Offers spending categorization, bill tracking, credit score monitoring, and budgeting tools. Free and user-friendly for basic budgeting and tracking. Personal Capital.com, a free financial dashboard that tracks your net worth, investments, budgeting, and retirement planning progress. Offers investment management services, fee-based, and free financial tracking tools. Great for comprehensive financial tracking and investment overview. Everydollar.com, created by Dave Ramsey, based on the zero-based budgeting method. Focuses on allocating every dollar of income to a category. Free version and paid premium version available. For fans of the zero-based budgeting approach and Dave Ramsey's principles. Goodbudget.com, another digital envelope budgeting app that syncs across devices and allows for shared budgeting with partners. Free and paid versions available. Good for couples or families budgeting together using the envelope method digitally. Experiment with a few of these budgeting apps and tools and choose the one that you find most user-friendly, effective, and that you can consistently use to manage your cash flow and track your financial progress. Technology can make budgeting easier and more automated than ever. Want to continue learning and stay inspired on your financial journey on the go? Here are top YouTube channels and podcasts for ongoing financial inspiration and education. YouTube channels. The Plain Bagel. Excellent channel that explains complex financial topics in a clear, concise, and visually engaging way. Great for in-depth understanding of investing and economics. Graham Stephan. Covers a wide range of personal finance and real estate topics with a straightforward and practical style. Practical personal finance and real estate advice. Andre Jick. Focuses on investing, personal finance, and wealth building, with in-depth analyses and research. In-depth investment analysis and research. Our Rich Journey. A couple documenting their journey to financial independence and early retirement, sharing their strategies and experiences transparently. Inspiring real-life FIRE journey and practical tips. Podcasts. The Dave Ramsey Show. Dave Ramsey's popular call-in show focused on debt elimination, budgeting, and personal finance principles, often more debt-averse and conservative approach. Popular debt elimination and budgeting focused podcast. Bigger Pockets Podcast. The leading podcast on real estate investing, covering various real estate strategies and interviews with successful investors. For real estate investing enthusiasts. Choose FI Podcast. Focuses on the FIRE, financial independence, retire early movement, interviewing people who have achieved financial independence and sharing actionable strategies. For FIRE movement inspiration and strategies. The Money Guy Show. Offers comprehensive financial planning advice, covering investing, retirement, insurance, and more, with a focus on rational decision-making. Comprehensive financial planning advice and rational approach. Planet Money NPR explains complex economic and financial topics in an accessible and engaging storytelling format, for understanding the broader economy and financial world in an entertaining way. Subscribe to these YouTube channels and podcasts and make learning a part of your daily or weekly routine. Surround yourself with financial knowledge and inspiration constantly. Lifelong learning is a key to long-term financial success. Final encouragement and transition of Section 12, and the entire video. And that completes your Financial Freedom Toolkit. These are just a starting point. There are countless other amazing resources out there. The key is to be a lifelong learner, to be resourceful, and to always be seeking knowledge and improvement on your financial journey. Remember, financial freedom is not a fantasy. It's a reality that you can create for yourself. You now have the knowledge, the strategies, the mindset, and the resources to take control of your finances and build the life you deserve. Take action today. Start with one resource from this list, and make it your first step towards continued financial education and empowerment. Your journey to financial freedom starts now. Share this video with someone you care about who needs to break free from financial limitations and unlock their potential for wealth and freedom. Let's create a ripple effect of financial empowerment. Thank you for joining us on this journey. Now go out there and build your financial freedom. You can do it.
We've covered everything you need to break free from financial uncertainty and start building true wealth. Now you know the truth about investing, saving, and financial growth. The biggest misconceptions that have been holding you back. The best tools and resources to keep learning, growing, and taking action. But here's the thing. Knowledge is useless without action. The people who achieve financial freedom aren't necessarily the smartest or the luckiest. They're the ones who take action, even if they're scared, even if they don't have all the answers yet. So ask yourself, what's the first step you'll take today? Let's hear from you. What's been the most valuable lesson you've learned from this series? Which financial topic do you want us to cover next? Are you ready to commit to your financial future? Let us know in the comments. Subscribe and keep growing. If you're serious about taking control of your finances, don't stop here. Subscribe to Economy for Everyone and turn on notifications to keep learning, growing, and unlocking new financial opportunities. And most importantly, share this video with someone who needs to hear this. Financial literacy is the key to freedom, and together we can change lives. Final words, this is just the beginning. Financial freedom is not a distant dream, it's a reality you can create. Everything you need is already in your hands. The only question left is, will you use it? Your future is waiting. Start today.